The probability of China cutting its trade surplus with the US responding to tariff threats proposed by President Donald Trump is absolutely nil. Beijing cannot respond to any direct demand put across by Washington. Nevertheless, there is a looming debt in crisis in China attributed to the efforts made by Washington in imposing a 25% increase in trade tariffs. At first, the 25% increase in tariffs on machinery and electronics exports appeared like a furtiveness tax on offshoring. In line with Trump's 2016 tax promise, any business that leaves our country, the tax increase centers goods categories such as nuclear components and semiconductors, in which US manufacturers based in China are performing well economically. If we take a closer look at the imposition of new tariffs on low-value exports involving Asian value chains, it appears that the new tariffs aim at possibly reducing the trade of cheap products bought by the US rather than targeting offshoring. Nevertheless, the US administration seems set on reducing its present account deficit, which is much lower than the 6% reached in the 2006-2007 financial year. This comes just as the interest rates are rising thanks to the US Federal Reserve legislation. Already, the 25% trade tariff increase has caused an economic crisis in China, with the currency, the Yuan, exchanging at 6.725 to the US dollar, the lowest rate in a year and 5% less than the exchange rate at the end of May 2018. With China's stable and centrally controlled currency, such an increase on trade tariffs is not easily felt. However, a stable currency is the government's promise to its citizens and can only be achieved by the central bank firmly managing the exchange rate to prevent an unusual increase. Investors in China have started exporting money, as seen in May 2018, where there was a decline in the foreign exchange reserves due to the uncertainty of the yuan's stability, despite buying official assurances guaranteeing the stability of yuan for almost a year. One sign of an impending economic collapse in China is the currency, in which, as much as China tries to display a well-performing economy courtesy of an increase in GDP, the crisis is evident, with passing clouds on trade, employment rates, and products consumption. The other evident sign is the decline in the Shanghai Composite Index of stocks by 7% in a month, plummeting for the first time since September 2016 below the set red line of 3,000 shares. Additionally, corporate bonds are being largely defaulted in addition to junk bond yields confounding. The economic crisis has even been made public, with the media reporting on the failure of the government to pay its employees or even meet pension responsibilities, further increasing the anxiety surrounding the declining economic situation. Property prices have not been spared either, as they are mainly dipping in major cities and frozen in others, as the government attempts to resolve the economic crisis by stopping property transactions. With this, coupled with a tremendous burden of debts, the economy will experience a recession. It is, however, difficult to estimate the precise state of the economic crisis, as the government tries to hide the situation by inducing financial institutions to push debts into alternative, opaque channels. The economic crisis is further worsened with the annual growth of lending, coupled with an increase in interest rates exceeding the GDP. Economic analysts emphasize that the government of China is in debt with many institutions, including banks, as it does not have the option of issuing the currency to such institutions in an attempt to keep the economy insolvent.
This is the annual look at the debt to GDP number for China over the years. And we can see it right now, it stands at 260%. These numbers here, the white, the blue, the green, as well as the gray, all represent the corporate debt, household debt, government debt, and the bank debt used here. These are at their biggest percentages to date.
One compelling argument in China's economic crisis is its central role in the global economy. Being the world's biggest exporter and second biggest importer cannot undergo a period of economic recess, as the world will always be in demand of the country's products. Nonetheless, the currency is an essential link between the domestic and the international economies. Therefore, its value hugely depends on supply and demand. China's economic crisis can be attributed to uncontrollable currency exchange, where cheap dollars find their way to the economy through legitimate and illegitimate channels, causing a structural surplus which indistinctively disappears without an increase in yield from the US. The central bank controls the currency in circulation by buying dollars and in turn issues yuan, and inflation is created when the central bank issues more yuan than the justified amounts of dollar inflow, creating an economic crisis. China has a clear history of governments from the Ming dynasty to Tiananmen being fallen by inflation. Going back to Trump's trade war, it appears that the increase in trade tariffs to China is ascribed to the Republican Party, who believe that the US for a long time now has paid expensively for its part in post-war leadership under the regime of Bretton Woods, whose slogan was "Placing America First," meaning that America should march alone. The global system of commerce has been undermined by the dollar standard rather than trade policies as usually thought. The US has largely been criticized for trying to dominate the global commerce by running trade deficits in an attempt to own the currency, therefore evading China's predatory policies. The expansion of global trade can be traced down to the second half of the 19th century with the rise of the gold standard. However, its collapse, which began in 1913, drove a trade implosion. The dollar became a global standard after the end of Bretton Woods' regime and the start of President Richard Nixon's administration, where the dollar was no longer redeemable for gold, instead was unfettered to become a pure fiat currency. With this enormous change in currency, the US currency was the strongest in the world, thereby immensely supporting the national economic growth, drastically improving the lifestyle of its citizens, exceeding productivity gains. In this regard, China projects its currency to undergo the same growth and be the strongest in the world. When closely observed, the recent depreciation in yuan's value, courtesy of the blunt effect of US tariffs, can be tempting, since China imports, relying on the capital account, can be of greater importance. Soon, it is certain China's central bank will try to lower the exchange rate to the US dollar. China authorities have been criticized to care less about foreign companies dominating the country's exports instead of caring about the pile of reserve gold and auspicious stock exchange entrances for Xiaomi Corporation and Ant Financial, which are of less importance to the plummeting economy. A clear revelation, however, is that China has adhered to the mercantilist trading policies since Mao Zedong regime. Most importantly, the investments binge since the years of economic reforms assisted to elites to amass billions from the savings accounts of Chinese savings. To date, China has succeeded in keeping its enormous non-performing debt afloat courtesy of capital inflows, therefore easing off the dollar pressure which could otherwise burst China's credit bubble. In the event of the credit bubble bursting due to a tighter dollar, the yuan would depreciate sharply, leading to a deflationary impact being felt across the world. Also, a decline in China's share of global GDP would be experienced, thereby intensely reducing the demand for products, leading to a diminishing role in the international political manifesto. It is evident that a considerable part of Chinese trade policies is openly biased. However, China experiences an unequal flow of trade policies, much from the US supporting established corporations at the expense of laborers as compared to Chinese structural subsidies. Nonetheless, it is difficult to resolve both problems, but not as compared to penalizing exports, which is even a more complicated program to address. In conclusion, China's economic crisis will not be beneficial to anyone. Therefore, Trump should reconsider his proposals. China's debt-GDP ratio is roughly 250%. They have $30 trillion in debt. Now things are slowing down, so they're printing more money in order to boost their economy. China's currency is not going down because they want to gain more trade exports. It's going down because they're juicing their markets with more cheap money. It goes back to gold. Gold is still the ultimate safe haven asset, and if this thing breaks out to war in the Middle East, kiss the markets goodbye and watch inflation and gold prices skyrocket.